The typical conversation between a growth investor and a value investor goes something like this. The growth investor says, Nvidia, Palantir, Microsoft, you're missing out, buddy. You must be allergic to making money. The value investor responds, all of these companies are way overvalued. You'll never make money by investing in the same thing that everybody else does. Stop being such a sheep. As you'll see, both of those investors should just deactivate their brokerage account and read a book about investing. Which one would you rather buy? A $1 coin for 80 cents or a $1 coin that could be $2 next year for $1.50? Most people would call the first value and the second growth. But in both cases, you're just trying to make money by paying less for the amount of cash you will get back. Labels make it sound like it's two different religions, but really it's just one simple question. How much cash is this thing going to throw off, and how much am I willing to pay for that? Figuring out what a stock is worth is just putting a price today on the cash that the business will send you over its lifetime. If the stream of cash is expected to grow, maybe because the business raises its prices or just sells more items, then the pile of future cash becomes bigger, so the business is worth more. And if the cash stream is expected to be flat or is expected to shrink, then that business is worth less than one that is growing. That's just common sense. So, where does the value versus growth myth come from? A common shortcut is to call low multiple stocks value stocks and high multiple stocks growth stocks. Anyone with a few years of experience in the stock market could tell you that in reality, paying a high multiple doesn't mean you'll get growth, and paying a low multiple doesn't mean you'll get value. Sometimes the market pays up for predictability, the steady, boring cash machine that rarely surprises. Other times, it marks down faster growing businesses just because the cash flow feels a bit more lumpy or a bit more cyclical. You can think of a rock solid retailer like Walmart. The sales are slow and steady, the business is very easy to model, and therefore that reliability is priced at a very expensive multiple. Walmart currently trades at around 60 times free cash flow. That means you pay $60 and you get $1 of earnings per year in return. That's double the S&P 500, despite the fact that Walmart hasn't really grown its cash flows in around 10 years. Now compare that to a company like Booking Holdings. Booking grew its free cash flow by 20% just last year. But travel headlines make people twitchy, and Booking doesn't trade for as high as a multiple as you would expect. It trades at a multiple of 20 times free cash flow, which is much lower than Walmart. Which of these two companies is growth? Which of these two companies is value? That's really difficult to answer just because the question makes no sense. Here's the core of the value versus growth debate. People confuse the multiple, which is a price tag, versus the business, which is the engine. When someone says, I only buy growth stocks, what they typically mean is, I buy high multiple stocks because I hope that the growth will show up. But a high multiple doesn't actually tell you how fast the company is growing, only how much the crowd of investors is willing to pay for $1 of that company's free cash flow today. You can think of a multiple as the price on a restaurant menu. A $25 salad isn't always tastier than a $9 one. Sometimes you're just at an airport or at a very touristy destination. Stocks are very similar. Yes, there is some link between price and quality, but hype, fashion, and fear can push the price around more than the actual underlying business. What actually creates value is the cash that the business can produce and for how long. Growth is just an input to that value, along with risk, moat, return on invested capital, and durability. The multiple is a reflection of those inputs. The multiple is an output, a reflection of expectations, of comfort, and sometimes of wishful thinking. Let's look at the other side of the coin. When people say they're value investing, what they typically mean is that they're buying stocks with low multiples. Yes, a low multiple can be a bargain, but it can also be a clearance sticker. Let's keep the food analogy going here. A half-priced avocado is great until you realize that it's brown inside. In this case, the low multiple gets you rotten cash flows. A fully priced avocado that stays fresh all week might be a much better buy. Let me give you two other examples of value traps. First, you have melting cash flows. You buy a cheap printer thinking you're getting a good deal, and then you realize that it's leaking more and more ink after just about a few months. Even though you paid for a very cheap printer in the first place, the cost of this purchase ends up being a lot higher because of all the maintenance required. Then you have investments with a very short runway. You get an end of season ski pass that's 70% off. You're very happy. You think you're getting a great deal. You make the purchase, and then you realize that there's only one weekend left in the entire season. In both of these cases, the multiple that you paid is low. You're paying a very low price, but it's for a good reason. You'll have to look elsewhere to find value. The key lesson is this: the price you pay for a stock says nothing about growth or value. These are not two different things. When people say they're switching their portfolios from value to growth or from growth to value, that's mostly marketing copy. Value already bakes in growth plus risk and durability. As an investor, your job never changes. You need to buy more future cash than you're paying for today. Now, if only there was a way to put this growth versus value debate to rest. Well, as it turns out, the king of investing himself has already taken care of that for us.
Growth prospects. Well, actually, I think you may be misquoting me, but I really said that growth and value, they're indistinguishable. They're part of the same equation, or really growth is part of the value equation. So our position is that there is no such thing as growth stocks or value stocks, the way Wall Street generally portrays them as being contrasting asset classes. Growth usually is a chance to, growth usually is a positive for value, but only when it means that by adding capital now, you add more cash availability later on at a rate that's considerably higher than the current rate of interest. So
the last sentence in that quote is quite a mouthful, but it's so important to understand for successful investing. Let's say you own a coffee shop and you decide to expand by buying 3 additional coffee shops in the same area. There is no doubt that you will grow the business. You will sell more coffees. But is this growth good or bad? That depends on how much you will earn on your original investment over time. If you spend $1 million to open each of those 3 new shops, yet each shop only contributes about a few $100s per month to your revenues, then that's like trying to fill your cup and it has a gaping hole in the bottom. As Warren Buffett says, if you tell me you own a business that's going to grow to the sky and isn't that wonderful, I don't know whether it's wonderful or not until you tell me about the economics of that growth. Let's look at a real-world example, like the airline industry. Air travel has been a growth business since the Wright brothers took off in 1903. Every year, more people board planes and travel by air than the year before. But funny enough, this growth is the worst thing that has ever happened to the air travel business. It's been great for consumers, but it's been horrible for airline companies. Because every year, more and more cash has to be invested for lousy returns. So at the end of the day, you always want to buy growth at a good value, which means intelligent investing is always value investing. You valued what the future cash flows are worth to you, no matter what the growth is, and you bought the company for less than that. It doesn't matter if you're buying a high-flying tech stock like Palantir or a boring bank stock with declining cash flows. Both can be value investing. What about you? Are you as tired as I am about hearing professionals talk about value and growth stocks and confusing the average retail investor? Or do you think there's actually some merit to having a difference between the two classes? Let me know in the comments below. Let's discuss. Thanks for watching, and I'll see you in the next video.